Hello and welcome. You're watching News9. I am Suyash Maheshwari and this is First Tick, where we break down the morning action on the D Street and the top stocks in the spotlight today. Now, Indian markets opened in the red with the first tick for Nifty coming in at 19,027 mark. Now, the sluggishness is on the back of a negative handover from global equities. Now, US markets tumbled in a broad-based sell-off on Wednesday as Alphabet shares slid after the Google parent posted disappointing earnings. Also hurting the market was a fresh spike in US Treasury yields, which has revived fears that interest rates could stay higher for longer. Benchmark S&P 500 index fell 1.43%, notching its fifth daily decline in 6 sessions to close below the closely watched 4,200 levels. Nasdaq, on the other hand, was down 2.43%, its biggest single session percentage drop since February 21. Dow Jones also ended modestly lower, down 0.32%. Now, the mutedness in US is also weighing on Asian shares as most of them are trading firmly lower this Thursday morning. Now, coming back to home, Indian markets have slipped below the 19,000 levels. As if we can see, Indian markets Nifty is down about 0.81% and is currently below. At 9:30 a.m. it was below the 19,000 mark, trading at 18,967 levels. Sensex, on the other hand, was down 0.78% at 63,571 mark. Now, these are the numbers from 9:30 a.m. this morning. The markets have slipped further from those levels. Nifty Midcap 100 was down about 1.5% at 9:30 a.m. trading at 37,982 mark, just below the 38,000 levels, and Nifty Small Cap 100 was down almost 2% and trading at around 12,196 mark. India VIX also saw a sharp spike. India VIX was up 8.3% at 12.25 levels. And with that, let me welcome our first guest on the show, Mr. Akshay Bhagwat, Senior Vice President at JM Financials. Also joining me in the studio is my colleague Amit Ranjan. Akshay, I'll come to you first. Now, just a month earlier, Akshay, hi Akshay, how are you?
Yeah.
Glad to have you on the show.
Yeah, good morning.
Good morning. Now, Akshay, just a month earlier, Nifty was, the overall market was very euphoric. Nifty was scaling new highs on a daily basis pretty much. Broader markets were buoyant. Many of the stocks were, scaling 52 weeks high. But in the last 1 month, and as of yesterday, Nifty has dropped about 1,100 points from its peak of about 20,222 mark. Now, the Midcap 100 index is also down about 3,000 points from its peak, and the Small Cap 100 index has corrected about 700 points. Now, I just want to understand what's your overall assessment of the, market sentiment from a technical standpoint, and should we brace for a deeper correction from here on?
Yeah, so on the technical front, there was a major development yesterday. The support area of 19,250, which was the low point of the prior 3 months, that was broken. So that was one of the most important technical development, because if you look at the charts in the past 3 months, time and again, there was demand at the area of 19,230 to 19,250. So clearly a technical support has been breached. This has been backed by short additions in the derivative segment. And also, if you look at the FII positioning on a broader scale, there has been large unwinding of long bets in the future segment, and also in the cash segment, there has been a continuous sell pressure. Besides this, even if you look at the India VIX, which you rightly pointed out at the beginning remark of your show, that has significantly picked up over 12%, which is a clear indicator that the fear is getting back into the system. So in wake of the geopolitical tensions also between Israel and Hamas, the rising crude oil prices, the bond oil, the bond spikes, these are all returning back. The fear is getting back. So from a technical perspective, assessing all the different scenarios, if I were to look at the Nifty, 18,900 is an important level which I would give relevance to, considering the fact that 4 or 5 months back, there was a strong breakout at the point of around 18,850 to 18,900. So I will give importance to these levels as the data stands right now. Technically, yes, we are highly oversold. So the chances of a mild relief rally from around 18,850 to 18,900 cannot be ruled out. We start with a new series tomorrow. So look out for these levels on the lower end. Broadly, if you were to look at the broader way the markets would behave, I would have special relevance, as I mentioned, to 18,850, 18,900. In case the market sustains below this in the month of November, then I need to review the charts and see if there is some serious panic in the market. As it stands right now, it's a minor correction in the entire wake of scheme of things, and you can expect some relief rally once the levels of 18,850 to 18,900 are tested.
Now, Akshay, as you mentioned, today is the weekly and the monthly option expiry for Nifty. What are the support and resistance levels that you will be tracking through the day?
See, 19,000 was a very important level. A lot of positioning was seen till yesterday at the 19,000 strike by the put writers. Now, unfortunately, the gap down opening in today's morning has rather been a surprise to the market participants. We have seen significant shedding in the put writing at 19,000 strike and shifting of the writing bets to lower strikes at 18,800 as it currently reads now for today's expiry. So things are not looking bright. Call writers are also shifting their writing bets to 19,000. There is a panic situation for the option put writers who have been aggressive writers at the 19,000 strike. So there is a tendency that the markets might slip in the first half of trade. Lower end, you might have 18,800 to 850 that also can be tested. So looking at a weak expiry today, mostly below 19,000 in the price volatility, expect 18,800 to 850 to be tested during the course of the day.
All right. Now, the banking pack, Akshay, I mean, between Nifty and Bank Nifty, we have seen a big drag coming from Bank Nifty on the overall market. And I was actually looking at the numbers. In the last 1 month, in the decline of about 1,100 points, HDFC Bank and ICICI Bank alone have contributed to 30% of that entire fall. Now, do you expect the weakness to continue in the banking pack? And what are the levels that we will be tracking through the day?
See, banking actually has given a clear breakdown, a bearish double top pattern, which we look on technical charts. That development took place couple of trading sessions back. So that gives you, one is a reversal sign in the Bank Nifty index. Second, it gives you a target roughly of around 41 to 41,500. So I'm more bearish on the bank index than on the Nifty index as it stands right now. As you rightly mentioned, ICICI Bank and HDFC Bank were the saviors for the bank index a couple of trading sessions back. But as you see it right now, even in yesterday's trade, both of these stocks have cracked significantly. Overall, the broader setup for HDFC Bank is weak. Even for ICICI Bank, as it stands right now, it has got below its major support zone. So overall, the way I read the bank index, it is in a weak trajectory. Yes, you might have some pullbacks here and there, considering the fact that we have almost lost around 1,500 points in a matter of 2 to 3 trading sessions. So pullbacks should be exited or sold into if you are a short seller looking for much significant downsides as we head into the November series for the bank index.
Now, Akshay, I mean, the numbers coming in from the banking pack have been rather good, compared to other sectors like your FMCG and IT. But what's weighing on the banking pack right now?
The way I see the result season, most of the result numbers starting from the IT sector, all the results have been good, but unfortunately, the way the markets are reacting, they are not showing much buying interest in the post results too. So I believe most of the result positive news are already had been factored in the prices. Even ICICI Bank, if you would see, as a matter of fact, had stupendous numbers. And unfortunately, if you see how it is reacting today, after such good numbers at 910 from 940.50 from the day the result numbers were reported, it's clearly a sign that market is showing no respect or no concern for the good numbers on the street. So the broader market sell-off is pretty intact. The mid-cap index has given a breakdown. The PSU banks have seen long liquidation. So clearly there is more slight panic or fear in the market as I see it. And in such a situation, there will be less weightage being given to numbers. Traders will foresee this as an opportunity to exit rather than to accumulate.
Hi Akshay, before we let you go, could you give us your top 5 picks for the day?
Yeah. Look, I have a balance of both buy and sell, considering the fact that we are highly oversold. So these are all technical short-term picks which I would recommend. The first one is short in SBI Life, which is SBI Life Insurance. You can short it at around 1311, 1318. Today, obviously, we have a gap down scenario. So most of the levels I would give, so you need to just consider it plus minus 0.5%. Keep a target of around 1272 to 1260 on the downside in SBI Life. Keep a stop loss of 1341. The second trade I would recommend is on Bajaj Auto, a very strong technical setup, strong reaction post its results last week. So it gives you another buy opportunity. So a possible buy candidate if you're searching in this weak market conditions, Bajaj Auto is the name. Buy at the current rate, target 5436 to 5467 with a stop of 5257. Another buy candidate I have is Reliance. The numbers are due I think tomorrow. A possible short covering candidate ahead of the results. Reliance would be a buy at current rate with a target of 2292 to 2310 with a stop loss of 2212. And MCX also is one more stock which has held strongly in the last few trading sessions. Although you might see it down today, but I believe in case of a recovery, this stock would react to positively. Buy at current rates with a target of 2320. 2347 can be the extended target with a stop loss of 2125. And lastly, Godrej Properties has a weak technical setup, short seen in the future segment. Sell Godrej Properties around 1600, target 1520. At 1492 can be your extended targets on the sell side. Keep a stop loss of 1652.
All right, that's the view coming in from Akshay. SBI Life, Godrej Properties on the sell side, whereas you can initiate buy positions in Bajaj, Auto, Reliance and MCX. Thank you, Akshay. Thank you for joining us this morning on News9.
Thank you.
Now, before we move on to our next segment, Amit, let's also talk about Asian Paints. Now, Asian Paints will declare its Q2 results today. What are the broader expectations?
It's expected to show moderate growth, and that is primarily because of 2 reasons. The monsoons and a late festive season. But it is exactly this very reason why, owing to the waterproofing segment of Asian Paints is likely to show big revenue results. Now, the net profits are expected to jump as much year on year, as much as 64% from 783 crores in the same quarter last year to 1,287.4 crores this year. This is primarily owing to the cost of their key raw material, that is titanium dioxide, that has gone down, and also year on year, the crude oil prices have dropped as much as 20% year on year. But sequentially, however, because of the factors that I named, the net profit number is expected to fall marginally by 19%. Revenues are expected to jump 7% from 8,457.6 crores the same quarter last year to 9,036.4 crores. Sequentially, again, they are likely to fall marginally by 0.5%. Operating profits are likely to jump 47% year on year from 1,227.7 last year to around 1,800 crores this year. Margins are going to be up, expected to be up, according to analysts, 628 basis points.
Wow.
From 14.6% last year to 20.88% this year. And the company, according to analysts again, the company is likely to plow back the gross margin savings into ad spends, basically to hive up sales in the coming festive season.
Yeah, definitely, as we are just stepping into the festive season. I mean, from what I can understand from the preview that you just gave out for us, quarter on quarter things don't look that great, but year on year we are expected to see a good bit of a jump in profitability as well as revenue. I think it's especially because of the softening of those raw material prices. We have seen crude prices rise on a quarter-on-quarter basis because of the situation that is going out in the Middle East. However, remember last time around we were just coming out of the war from Ukraine, because of which crude prices were over $100 a barrel. So I think that will play a key factor as far as margins go on a year-on-year basis. But as you just said, I think sequentially there will be a decline.
the company is expected to brace for the coming jump in crude prices because there is unrest in the Middle East. That's a fresh one. And that is why just to in order to brace for that, the ad spends are going to increase to basically get the customers.
Right, right. I mean, I'm also looking at the stock of Asian Paints this morning, Amit. It's down about 1.5%. I mean, in the last 1 month or so, the stock has lost about 7% of investors' wealth. I think that's primarily because of the volatility that we are seeing in crude prices, where they have, scaled up to those $99 a barrel mark. However, they have softened and are currently hovering around that $90 barrel mark. I think also another reason why Asian Paints stock is under pressure is the fact that Grasim is looking to make a foray into the paints business, and from what I understand, it's eyeing for that number 2 spot. Asian Paints sits firmly at the number 1 spot, but there will be some competition emanating from the entry of Grasim, I think it seems.
Therefore, the reason to basically brace themselves in their distribution and customer acquisition segments. Therefore, the ad spend.
All right, that's the view on Asian Paints. I am made to understand that Kush Bohra of kushbohra.com has also joined us. Hi Kush, good morning. Always nice to see you. Now, we were just discussing earnings. 2 companies came out with their earnings yesterday, Axis Bank and Tech Mahindra. Now, I want to talk about Axis Bank first. It reported a healthy set of numbers, but what stood out for me was that loan growth was at the best in 7 years, whereas the company also saw NIMs, which is net interest margin, improve sequentially, whereas other banks reported a sharp decline. What is your assessment from Axis Bank's Q2 report card? And if you can give us an outlook on the stock as well.
Hi guys, first up, thank you for having me on the show. Always a pleasure. Well, I'll come in on this from a more technical perspective, as I always do. Well, see, one of the few stocks that we think from the private space is going to do well is actually Axis Bank. Look, HDFC's got troubles of its own. ICICI is lacking momentum, and Kotak again, has not been a stock, rank outperformer in any manner. So I think Axis Bank from the private space continues to remain our top picks. The fact that the numbers have been healthy was already sort of reflecting in the in the price, where you could see a relative outperformance in the stock. Now, if I see the overall setup of the stock for the last, let's say, 6 to 8 months, ever since the March low that it made, the stock's actually been on an uptrend. The fall that we're seeing right now is more in terms of the overall selling that we are seeing in the banking space. But this for me is turning out to be a buying opportunity in Axis Bank. We think from the lows of about 920, 930, where it's a very strong support zone that the stock has, as long as that level is held, the stock could actually rally up to 1025 and even 1060 levels. So once the dust settles and once the market sort of starts to find its base, Axis will outperform from here, and it'll not be a bad idea to hold on to this one, especially if you have a positional view anywhere from 1 to 3 months. Axis does remain our top pick from the private banking space.
That's the view from Kush on Axis. I mean, I'm looking at the stock also, Kush. It's the only stock in the Nifty banking pack that's in the green. The Nifty banking pack currently, as of 10:04, is down about 1%, whereas Axis Bank is up about 1%. So clearly, I think the outlook is bullish as far as Axis Bank goes. Amit, I think Tech Mahindra is another one which you want to discuss.
On the contrary, Tech Mahindra, Kush, posted very uninspiring results. The sharpest fall in net profits in 16 years, margins declining as much as they did. What are your views on that?
One word: avoid. And I'll give you a very simple reason. If you look at the entire IT space, if I have to sort of rank out, the stocks, it will be HCL Tech, TCS, and Infosys among the top names, and from the lower ones, it's the likes of Persistent, Bsoft, Coforge. So the likes of Wipro, Tech Mahindra don't really even fall under our purview, at least. And if you see that sort of again corroborated by the price movement, not just now. If you look at September onwards, when the stock made a 1300 high. Ever since then, we've seen a sharp fall without any meaningful kind of recovery. Today, after the numbers have come out, the stock's actually below its 200-day moving average, which has not happened since I think about early May. So I think the stock's actually very clearly in a downtrend, you could expect a technical rebound on this, which could take it to about 1000, 1150 kind of levels, but nothing meaningful. I wouldn't really buy into that dip or, go bottom fishing or, value hunting in this one. For me, Tech Mahindra is a very clear avoid.
All right. I mean, the stock is also not doing too well this morning. Is down about 3%, whereas the Nifty IT pack is also down about 1%. I think HCL is the only stock trading in the green, whereas all other constituent stocks are in the red, and Tech Mahindra is the worst hit, down about 2.7%. Now, Kush, also I want to get your view on the broader markets. I mean, in the last 1 month, we have seen Nifty, give away around 1100 points. At this time, we were also talking with the other guests that, this time around last month, we were talking about all-time high levels. Stocks were doing, were on such a good run-up. But this time around, the mood overall has kind of turned somber. What are you picking up? Is it a sell-on rise market, or does the, overall, after this correction that we have seen, is a bounce back expected?
So look, investing or trading, either of the activities are based actually on your time horizon. Now, just to put things in perspective, while you're spot on in the sense that, the markets, Nifty and the broader markets included, have seen a very sharp fall. But let me just put it in context, we started the year when the mid-cap index was about 30,000, 31,000 odd, and ran up all the way to 41,000, which means it saw a jump of nearly 33%, and we're talking index jump of 33%, right? In a span of what, 8 to 10 months. Now after that, the mid-cap index is now down to about 38,000 levels. We are seeing some correction about 10 to 15%, but that is perfectly in line, despite the kind of recent downturn that we are seeing. Even as of today, mid-cap index is seeing gains of 20% plus, and again, as I said, this is index. The stocks have actually been doing phenomenally well. So if your horizon is 6 to 12 months from here, I'm very sure that these dips will turn out to be buying opportunities. Of course, you have to be very stock specific. The same thing applies to Nifty, even Bank Nifty for that matter. See, if we look at it from a technical perspective, the index, Nifty, Bank Nifty both have gone into oversold territories, where the RSI is now down below 30 for both the indices. PCR is below 0.7 for both of them. Why aren't we bouncing back despite these indices being on in oversold territories? Because you've seen massive call writing over the last 3 to 4 days, and today's the monthly expiry. So there's a bright chance that tomorrow, or perhaps in the coming week, once this expiry hangover is over, the index will rebound. So if your view is near term, wait for the expiry to get done. You might find a technical rebound on this stock, on index, on Nifty and Bank Nifty both. But that is not to say that the near-term pain is over. But if your view is 6 to 12 months, then I think this is a good buying opportunity. You should look at buying, the stocks that you always wanted and thought were pricey. It applies to, mid-caps and, Nifty, Bank Nifty stocks as well.
Now, interesting that you talk about mid-caps, because, whenever there's a bearish sentiment in the market, the broader markets are the first to lose. What's your overall take? Should we, keep on betting on mid-caps and small caps? Because yesterday we did not see them declining as much as the headliners did. Although today they are, sharply down, I think about 1.5 to 2%. So what's your overall view here? Large caps or the broader markets?
So I would still pick mid caps. I know, because they were a little frothy, the inclination towards them was a little less, and that is quite right. But now, with the kind of correction that we are seeing in some of these names, they're becoming quite attractive from a price point perspective, at least. And, if you put things in perspective, if someone was invested in the large cap names for the last year, maybe 2 years, the returns haven't been great, right? I mean, if I talk about the big boys, the Reliance, HDFCs and Infosys of the world, they haven't even beaten the FD returns, if you see. So the pain from that perspective also is very real. I still bet on the India story, so I still bet on the mid-cap story. It's just that there's the fall right now. You may not want to catch a falling knife, but once the dust settles, it's a good idea to again start participating in select mid-cap names that have a strong business, that have a strong fundamental model going for them. So for me, mid-caps will remain the theme. I'm just waiting for this fall to settle down.
Now, Kush, what I'm getting from you is that, perhaps over the next few weeks, at least, at least investors should look at sector-specific allocation, stock-specific approach. Where do you see value in this current market?
So a couple of places, that sort of are expected to do well. I know banking right now is down and out, and it seems like it's in the doldrums. But the entire financial space is something that I have on my radar. So a couple of NBFCs and a couple of stocks from the banking space are something that I will look for as a value buying opportunity. There is also the auto space, which was doing very well, has not really given way. And then thirdly, there is the real estate space. With the interest rate scenario sort of very close to peaks. Certainly far away from the what you call the bottom, a bit closer to the top right now. The real estate pack also looks nice. So the three spaces that I have on my radar from a value picking or a buying perspective are the financials, as I said, the auto, and the real estate. Now the real estate pack is a little broad for me, where I'm including the likes of home improvement themes as well. So some of these names in this fall just become a little more attractive for me.
Hi Kush, Amit here. In the October correction that we are witnessing, alternative asset classes like crypto, gold, real estate are the ones who have done fairly well. Do you think it is time to move away from equities for the time being?
And also, should we allocate some of those funds to these alternatives? I mean, you were just talking about real estate, but gold, crypto, what's your overall view there?
Well, it might not be a popular view, but I'm not a very big fan of, crypto. So I wouldn't really comment on that. See, as far as gold goes, as far as real estate goes, being a SEBI registered investment advisor, I firmly believe in the fact that you should have a proper diversification in your portfolio. And from that perspective, they make sense. But let me just, let me just get down to a little, practical aspect. In India, if you see a lot of real estate investment, at least in the tier 1, tier 2 cities, will come out of the profits or the money made in the equity markets. Once you've started investing in the equity markets, it'll just give you that fillip, that boost. So if the equity markets are performing well, that's when you will see the real estate market also doing well. If the equity markets aren't doing well, the real estate market will also perhaps struggle. Gold is a different animal altogether. You should always have gold in your portfolio from a safety perspective as an inflation hedge. So that's never a doubt that you should have. And I mean, not as an ornament for your the ladies in the house. It's as a proper investment class. You should have gold even as biscuits or bars, and if you prefer that, or at least as an ETF. For sure, but real estate is something that for me is quite strongly linked to the equity markets. So I would rather play, the real estate space via the equity markets. As I said, it could be the developers, it could be the financiers, or it could be the home improvement themes that I would bet on, rather than have an investment in a real estate property directly.
All right, that's a view coming from Kush Bora. Kush, always a pleasure talking to you. Also, Amit, thank you for joining us in the studio. But with that, it's a wrap on First Take. Keep watching News9.
Literally every major power in the world is gearing up